Hello everyone, thanks for checking out my video. There is one phrase that has been echoing throughout 2024, and that is all-time high. Last week, the S&P 500 and Dow Jones reached record highs again. At this point, I have lost track of how many times these indexes have hit all-time highs this year. Anyway, the latest rally was likely driven by a new set of positive economic data. We will go through them later in this video. To add on, year-to-date S&P 500 is up about 20%, and with the third quarter ending on Monday, the index is on track for its strongest January to September performance since 1997. I have more interesting statistics to share in this video, so do watch all the way till the end to find out more. So, all three major US indexes clinched a third consecutive weeks of gains. Investors appeared to be cheering on the series of good news and positive economic reports. First of all, the latest initial jobless claims fell more than expected, which implies a strong labor market. In case you're not aware, the Fed has sort of shifted their focus from inflation to job market now, and this set of news is definitely welcomed by the Fed. Next up, we had the final reading of second quarter GDP coming in at a solid 3%, a faster rate than Wall Street had expected, which is an annualized growth of 2.9%. Thirdly, the core PCE index, which is the Fed's preferred inflation gauge, rose 0.1% month over month in August, which is lower than Wall Street estimates of 0.2%. The year-over-year PCE index increased by 2.2%, also lower than the expectation of 2.3%. That is also the lowest since February 2021. All these numbers point to a further progress in the Federal Reserve's efforts to bring inflation closer to their 2% target. Finally, the University of Michigan's Consumer Sentiment Index rose to 70.1 in September from 67.9 in August. This has exceeded the market estimate of 69.3. Consumers expect inflation to continue falling and also expect the economy to improve. Well, it seems like everything is falling nicely in place for a soft landing as the Fed embarks on the rate-cutting campaign. The only wildcard at the moment is probably the upcoming presidential election. Okay, by now we can safely say that this September has defied the odds and historical bearish trend as it marches towards a positive month. As we welcome the new month October, and with the stock market pricing in a soft landing scenario, the new jobs report will play a huge role in setting expectations and probably the market trend for the month ahead. The September jobs report, which is scheduled to release on Friday 4th October, will give the Federal Reserve and investors the latest insight of the labor market. If the unemployment numbers stay within expectations, that will likely give the market a further boost as it will go very well with Federal Reserve's latest goal, which is to keep unemployment rate low. In case you don't know, one of the main reasons why the Fed had announced a supersized 50 basis point rate cut recently is to protect the labor market after inflation has fallen substantially. On the other hand, if jobs numbers come in weak and worse than expected, I'm quite sure market will start to speculate if the Fed was too slow in cutting interest rates. Anyway, before the jobs report is out, on Monday, 30th September, Jerome Powell is set to speak on the economic outlook before the National Association for Business Economics. Investors might be looking for signals on the Fed's next rate cut move. Meanwhile, do also note that October marks the start of a new quarterly earnings season, which will begin from the second week of the month. Therefore, expect high level of volatility leading up to the US presidential election in November. On a side note, if you are invested in Tesla, this will be a big month for you as well, with 3 catalysts or key events coming up, namely its latest quarterly delivery numbers, robotaxi event, and the last quarter's earnings. Alright, moving on, let's now read some charts. SPY, which represents the broad index S&P 500, hit yet another all-time high last week. If you had followed my last video, you probably could recall that I mentioned at all-time high, it's anyone's guess on how high will the market go before market makers start to take profits. Well, based on the chart, you can see that SPY created new record high 3 times last week before a small pullback on Friday. Interestingly, the pullback stopped at the 61.8 Fibonacci extension level at around 571. This is one big support level to watch. If let's say SPY bounces off it, which means it's doing a classic retrace, retest and rebound. When this happens, it may go on to break the recent newly created all-time high at 574. Similar to what I have mentioned in my previous video, based on Fibonacci extension, a meaningful resistance will come in at around 580. But again, I have to caveat or remind that at all-time high, really it's anyone's guess on when is the next significant sell-off or pullback. On the other hand, if the 61.8 Fibonacci level at 571 doesn't hold this week, I see a very high probability for SPY to continue to fall towards 563 to 565 area. This is an area where SPY had difficulty breaking above previously. But that also means this previous resistance had turned into a support area. Actually, it's quite a decent support zone in my opinion. So if there isn't any change in the overall market trend, this area should hold. Which also means if it doesn't hold, be very careful if you're holding on to call or long positions, because we could see SPY dropping below 560. Next up, let's have a look at Apple's chart. Apple is in no man's land in my opinion. It basically traded sideways for the entire of last week. Come this week, it's quite straightforward for both the bearish and bullish thesis. Okay, for Apple to be bullish, it needs to break above the bearish triple top pattern by going above 233 at least. For confirmation, I would want to see Apple testing the recent all-time high of 237, and if possible, close above it. So yep, to summarize, 233 and 237 are the levels to watch for the upside. On the other hand, in terms of the bearish thesis, watch for 224 as a support level. If that breaks, that is the very first sign of bearishness. At 224, I would expect the market makers to bring Apple towards the 50 moving average at 222 and fill the gap between 222 to 224 in the process. Alright, if Apple bounces off from here, that's good news for the bulls. But if it breaks, be careful because we may start testing the next Fibonacci level at 219 and perhaps even fill that tiny gap at 216 to 217. And what didn't impress me was the MACD bullish cross. It basically lacked strength as Apple chopped sideways, and a decline towards the 50 moving average could see MACD reverses and we might then see a bearish cross. When that happens, things may not look very positive for Apple because it could be a start of a new bearish trend, at least in the short term. Therefore, watch this MACD closely too, especially towards the end of the week. Okay, all that being said, it seems like 224 to 233 area is a nice consolidation zone for Apple as it was consolidating around this area on two other occasions. This is the third time. If Apple continues to move within this range this week, then it's neither bullish nor bearish. Moving over to Tesla's chart. Wow, Tesla, simply amazing. Since it hit that low of 182, it has rocketed 44% as it closed at 260 last Friday. I think it's not difficult to interpret the chart. Just look at this uptrend, look at that purple trend line, and look at the price action where Tesla kept creating higher lows. Tesla is bullish, as simple as that. In fact, in my last video, I specifically mentioned that overall, Tesla is looking bullish. That was the reason why I sold a cash secure put last week, which is a slightly bullish move. More on that later in the options trading section. Alright, before the bulls get all too excited, let me just keep you in check. If you were to zoom out the chart, you will notice that every single time when Tesla has such a monster and parabolic run up, it is usually followed by a big movement down. Okay, don't get me wrong, I'm not saying it will definitely happen again this time, but in case you're not aware, we have a big catalyst this week for Tesla, which is the announcement of third quarter deliveries. It is likely to happen on Wednesday, 2nd October. Based on the past few occasions, Tesla can swing wildly after the numbers were out. Sure, if the numbers are good, Tesla may swing up to 270s or even higher. But what if the numbers are poor? The downside can be equally massive as well. It's really a flip of a coin, and this is why if I have missed the huge run-up recently, I will adopt the wait and observe approach this week. Anyway, if the market doesn't like the delivery numbers and if there is a sell-off, watch for two levels, which are the 61.8 Fibonacci level at 237 as well as the purple downtrend line. From the current price of 260 to 237, that's a close to 9% drop. But honestly, that would not concern me because it's Tesla. What's a 9 to 10% movement, right? But if the two support levels break, then I think bulls should be a little concerned. From there, watch the 50 moving average closely at around 222. If I'm holding on to some call options, I wouldn't want this level to get breached. Because if it does, I do think there is a high probability for Tesla to hit low 200s, where the 200 moving average is. On the other hand, if the market likes the latest delivery numbers, I think there is a little resistance to prevent Tesla from hitting 270s range. When that happens, there could be a slight chance for Tesla to hit that gap area between 280 to 289. Finally, don't forget, there is another huge catalyst taking place on 10 October, where Tesla will talk about its robo-taxi plan. It's another event where we cannot be certain which direction will Tesla's share price move. But we can be pretty certain that the movement is going to be huge, so mark your calendar, alright? And oh, before I forgot, Goldman Sachs is recommending investors to buy Tesla call options ahead of its two big events. I don't know about you, but it does sound fishy to me. Seems like Goldman Sachs could be selling the call options to you, or they could be pumping the share price up so that they can dump on retailers later. Anyway, this is just my wild guess. Meanwhile, I am positioning myself in a cautious manner as I watch the two events unveil. Jumping over to Google's chart, Google seems to be facing a bit of resistance at the 38.2 Fibonacci level, which is around 164. As you can see from the chart, it has been testing and trading right below it for 7 consecutive trading days. Coincidentally, this is where the 50 moving average is also at around 163. Alright, come this week, if Google gets rejected by this 163, 164 levels again, it may retrace towards 158 where the next Fibonacci level is, as well as where the 200 moving average sits. This is the one level that I will be excited. Why so? First of all, I have mentioned previously that the 200 moving average has proven to be a strong support level. The last time round when Google went below it, I sold a put contract on 6 September to be exact, and since then, Google has bounced up and the trade is currently up by 88%. Therefore, if Google declines to this level again, I may consider selling another put option. Another reason is because if, a big if, Google bounces off 155 to 157 area, we could potentially see an inverse head and shoulder pattern. Again, I must emphasize this is a big if, so watch the 200 moving average and the 155 to 157 area closely, alright? But all said, if Google breaks below these support levels, then it's very bearish and we could hit below 150 possibly. On the flip side, if Google can go above 164 without even any retracement from this point, then it's slightly bullish. The longer it stays above 164, the better it is, because that will naturally bring us towards the next Fibonacci level at around 169. From here, give and take a little bit, I would expect Google to probably kiss 170 level. Let's now hop over to Meta. If you have been following my videos for the last 2 months, you would probably have heard this couple of times. The bullish inverse head and shoulder pattern and the target price of 600 by the end of the year. Right now, the bullish pattern is playing out as Meta broke above the neckline. It has since climbed from 550s to 560s and it hit 570s last week. We are almost there in terms of hitting 600 for the pattern to play out completely. But like I also mentioned, take this 600 level with a pinch of salt. I mean, theoretically speaking, if the inverse head and shoulder pattern pans out, it should hit 600. but nothing is guaranteed in the stock market. So if you are banking on that 600 level, please do it with care. Anyway, Meta's runner is a bit like Tesla, a little overextended and is hitting overbought level soon. So if it decides to take a break this week, watch 544 as a support level. If that breaks, then be on alert a little bit. I will be on my toes if Meta hits below 530. Because when this happens, we can kind of say that the bullish inverse head and shoulder pattern is invalidated. That's when you might want to consider pivoting your position to bearish, because Meta could be heading towards the 50 moving average at around 515. This level is near to the little gap between 512 to 514, so don't be surprised if this gap gets filled. On the other hand, if Meta remains above 544, then we are good. The bullish momentum is still intact. We could have little retracement here and there, and Meta may continue to grind up in a zigzag manner. By the way, Meta is estimated to report earnings on 23rd October, and that could be the catalyst to decide if we can hit and stay above 600 by the end of the year. Okay, let's now check out Microsoft's chart. Among the stocks that I cover in the technical analysis segment, Microsoft's chart looks the most bearish to me. Note, I am comparing it with other stocks that I cover. I'm not saying Microsoft is very bearish, there's a difference. Anyway, 8 red candlesticks out of 9 trading days, you probably could tell it's looking bearish. To add on to that, there are 2 more bearish signals. First of all, Microsoft seems to have difficulty breaking above the critical 61.8 Fibonacci level at around 436. It did go up a little bit for a day or two, but came back down pretty quickly. This means buyer kept stepping in to push the share price down. On top of this, the MACD is on the verge of crossing down. If that happens, then a new bearish momentum could start. Interestingly, the last time we had a bearish MACD cross, Microsoft reversed it quite quickly. Let's see if it can do it again this time. If it can't, then I would expect Microsoft to test both the 50 and 200 moving averages at 420 and 414 respectively. In terms of the bullish thesis, quite simple. Get above 436 and stays above it with nice green candles. Not that kind of peekaboo red candles we saw last 2 weeks, alright? The longer it stays above it, the higher chance the bullish double pattern could play out, and that will bring Microsoft towards 460's range again. Finally, let's have a look at Nvidia. I love how Nvidia is testing this blue downtrend line that I drew previously. It was trying to get above it, but got rejected after going above the trend line for a day or two. That's not looking too good. Not just that, Nvidia is floating at the critical 61.8 Fibonacci level at around 122, and it appears to be lacking strength to stay above this level. On top of all this, the 50 moving average is about to cross below the 100 moving average. Though this is not a death cross per se, which is defined by 50 moving average crossing below the 200 moving average, it is still considered bearish. But for confirmation, we will need the 100 moving average to curl downwards as well. Anyway, coincidentally, both moving averages are currently meeting at where the 50% Fibonacci level is, at around 116, thus making it a triple support level. If this strong support level breaks, I think we could easily slide towards 110 at least. All in all, the bulls will not want to see 100 to 102 area gets breached, because if that happens, there is then a very high probability for Nvidia to continue falling towards the low 90s range. Okay, in terms of the upside, quite straightforward. Get above the 61.8 Fibonacci level, get above that blue trend line, print a few nice green candles, then we can say bullish momentum is here. But for a full breakout for Nvidia, we need it to go above the recent high of 131. That will then open the door towards July's high of 136. Alright, moving over to the options trading segment. 2 trades to update this week. The first one is this cash secure put on Tesla that was sold on 21st August. The strike price is 190 and the contract expired last Friday, 27 September. Okay, the main reason for selling this put contract was because Tesla was looking slightly bullish in the short term with a series of higher lows. On top of that, there was a bullish cross on the MACD. Last but not least, it also went above the 50 moving average with 3 solid green candles just a few days before I opened the trade. For more information about this trade, you can check out the video link at the top right hand corner. Anyway, after I sold the contract, Tesla actually retraced a little bit, but shortly after it bounced off a double support level formed by the 23.6 Fibonacci level and the 200 moving average. Since then, Tesla went on this monster run-up as it climbed more than 25% in the next 1 month. With that, Tesla closed below my strike price of 190 last Friday, and the contract expired worthless, which means I got to keep the full premium of about $280 without having to close the position. Okay, the second trade to update is this new cash secure put on Tesla that was sold last Thursday, 28 September, expiring on 8 November with a strike price of 190 again. I think this is the third put contract with 190 strike price. Honestly, there's nothing magical about this strike price. It is just a price whereby I don't mind getting assigned with 100 shares of Tesla at 190 per share if the trade goes wrong. Anyway, the thought process behind this trade is pretty straightforward. If you had followed my last video when Tesla was trading at around 230s to 240s range, I specifically said that Tesla is looking bullish in the short term until the purple trend line and the 50 moving average got breached. And with Tesla going above the 61.8 Fibonacci level convincingly, I stepped in to sell a put option, which is a slightly bullish move. I mean, if this momentum continues, we could easily hit the 270s range. But here's a caveat. There are two major events or catalysts that may affect this trade, and they are the report of Tesla's latest quarter's delivery numbers in early October, probably 2nd October, as well as the robotaxi event on 10 October. If the numbers and news don't excite investors, the downside for Tesla could be massive. When that happens, again, like I said, if Tesla falls below 190 on expiration date, I don't mind taking 100 shares of Tesla at this price. From there, I will sell covered calls to get more premiums. This was something that I have done previously until the shares got caught away. And in case you don't know, this is called the options wheel strategy. If you are not familiar with this, feel free to check out the video linked at the top. It's very beginner friendly. Okay, at the start of the video, I shared that there are some interesting statistics to share. First of all, historical data shows that the strength of S&P 500 so far this year bodes well into the end of the year. According to Trust Advisory Services, since 1950, the S&P 500 has gained at least 15% through September in 17 instances. And in the fourth quarter of those years, the index rose a median of 5.4% and gave a positive return in all but 3 of them, which gives us a 82% chance of a positive fourth quarter in 2024. For information, S&P 500 is up about 21% year to date. To add on to that, if the index closes in the positive territory in September, this would mark its 8th positive month of 2024, except for April this year. According to Carlson Group, there has only been 9 previous years that the S&P 500 registered positive gains for 8 out of the first 9 months. In every one of those years, we saw a winning fourth quarter, giving an average return of 6.7%. All in all, if you just purely look at historical trends and performances, the odds favor the bulls. But wait, doesn't this sound familiar? Remember, September has historically been a bearish month. For instance, the last 4 Septembers have given a negative return ranging from negative 3.92% to 9.34%. But then, what happened? We only had a sell-off on the first week of September this year, and then the market rallied hard for the remaining of the month. So my point is, be aware of the historical trends, know the odds is in whose favor, and if you wish to go the opposite, just be a little bit more careful. But if you want to go with the trend, don't go all in, and be mentally prepared that things could be different this year. That's the message that I want to bring across. Overall, the tailwind for the stock market remains intact, with the Fed cutting rates against a backdrop of a falling inflation and a resilient labour market. As the rates continue to go down, generally speaking, it should benefit most companies as the cost of borrowing will be lower. But of course, there are certain sectors that would benefit more in a lower interest rate environment. One last thing, things are looking good and rosy now, but do keep in mind that there is the US presidential election coming up in early November. That is one big wildcard which could swing the market. Also, as the market rallies, watch the fear and greed index. When it touches the extreme greed level, I would be a little more careful. I mean, I remain bullish, but I will also be cautious at the same time and not to chase a raging bull. Okay, if you found my weekly free content useful, do help me grow this channel by tapping on the like and subscribe buttons if you haven't. Thank you very much.